Welcome back to The Explainer. I am absolutely thrilled to have you here today because we are unpacking one of the most fascinating mysteries in the crypto markets right now. It's a situation that honestly has traders scratching their heads and fundamental analysts practically jumping out of their seats. We're looking at the Sky protocol, which you might remember as MakerDAO, and a really central paradox surrounding the Sky token. Today, we're going to look at what happens when a project does everything right on paper, but the market reacts in the exact opposite way you'd expect.
$124 million. That is Sky Protocol's record-breaking gross revenue just for the first quarter of 2026. To put that into perspective, they didn't just have a, good quarter. They had the absolute strongest, most profitable quarter in the entire history of their protocol. But the reality of this situation creates some absolute cognitive dissonance because on one hand, we've got that massive $124 million revenue figure, right? A totally booming business. But on the other hand, on the very day these stellar results were being digested by the market, alongside a broader market downturn, the Sky token experienced an intraday drop of 7.7%. So if the business is fundamentally booming, why is the token bleeding? Well, that's exactly the question we're answering today.
Okay, let's dive into this with Section 1, the Sky Business Engine, decoding the fundamentals.
Before we get too lost in the crypto jargon, let's just break down exactly what Sky Protocol is. So formerly known as MakerDAO, you can basically think of Sky as a highly sophisticated, automated money manager. It operates a lot like a traditional, real-world banking model, but it's built entirely on the blockchain. So it takes in capital, deposits, and it scours both decentralized finance and traditional finance to find the best possible yields. It then passes a portion of that yield back to the depositors and profits on the spread. Honestly, it's a highly durable, revenue-generating machine. And this isn't just a flash in the pan either. Look, a year ago, in Q1 2025, they did $96 million. In Q4 2025, sure, they saw a slight dip down to $79 million. But then revenue just jumped to an impressive $124 million in Q1 2026. We're looking at a business with revenue accelerating by nearly 29% year over year. In the highly volatile world of crypto, that kind of consistent cash flow is incredibly rare.
So where is all this revenue actually coming from? Well, the total stablecoin supply within the Sky ecosystem is sitting at a staggering $11.7 billion. And the explosive growth here is largely being driven by massive institutional demand. Over half of that entire pie, $6.49 billion, is sitting in USDS, which is the yield-generating version of their stablecoin. They literally just crossed the $5 billion milestone for USDS, which really just proves that big capital is flocking to their platform for reliable returns.
But how do they actually generate that yield to pay out? Well, that brings us to their growth engine, the Sky Agent Network. You can think of entities like Growth, Spark, and OBAX basically as a startup incubator for yield. They take that massive pool of USDS and deploy it into real-world assets. We're talking about things like digital mortgages, AI compute, and energy infrastructure financing. They're creatively sourcing yield from outside the standard crypto echo chamber and bringing those profits right back into the Sky ecosystem.
Now for the culprit behind the token price drop. Section 2, the governance plot twist, the $150 million reserve pivot.
So Sky recently introduced a new treasury management function, or TMF, which is basically a strict 4-step waterfall for exactly how they spend their revenue. Step 1, pay for security and maintenance. Step 2, fill a solvency buffer up to a $150 million target. Step 3, token buybacks. And Step 4, staking rewards. Now, and this brilliantly illustrates the whole issue. Can you spot exactly where the money is getting stuck? Yep, it's Step 2. Until that $150 million buffer is totally full, the really lucrative token buybacks and rewards down in Steps 3 and 4 are being drastically reduced.
It is literally the classic marshmallow test, but playing out in decentralized finance. Sky's governance essentially voted to sacrifice immediate gratification, meaning they slashed their daily programmatic token buybacks by over 87% in order to build up this institutional-grade rainy day fund. They're prioritizing long-term trust and solvency over, short-term price pumps. From a business perspective, it's incredibly mature. But from a short-term trader's perspective, it completely cuts off the immediate buying pressure.
Which brings us to this absolutely crucial number right here, $50.9 million. That is exactly where the solvency reserve sits right now. So what does that actually tell us? Well, it tells us that they still have a gap of nearly $100 million to fill before they reach that $150 million target. And that means it's going to take some time before those really aggressive token holder rewards and buybacks actually resume.
Let's take an impartial look at both sides of this. Section 3. bull case versus bear case, market sentiment versus fundamentals.
Okay, so the bulls are looking at the really heavy institutional backing. Tether recently made a $134 million strategic investment, and a publicly traded company, NovaBay, which is now SDEV, has scooped up a massive 9.15% of the entire Sky supply. They are heavily betting on a deflationary flywheel, where constant token buybacks and burns over the long term increase scarcity and drive up value. But on the flip side, the bears are looking at the immediate short-term environment. The broader crypto fear and greed index is currently sitting at a fearful 29, driven by macroeconomic headwinds like capital leaving Bitcoin ETFs. Plus, on-chain analysts recently spotted a 69 million token transfer by a whale, which signals some potential selling pressure.
Let's hear directly from the community on this. A fundamental analyst on X posted this: Sky's upgraded tokenomics prioritize long-term solvency. Tether's $134 million strategic investment validates Sky's stability. You see, this perspective entirely ignores the short-term price action and focuses heavily on the fact that big, institutional money is actively validating Sky's new, highly mature financial model. But of course, we have to balance that out with the traders who are dealing with the reality of the charts today. Another user noted, "The trend is bullish, but the market is testing a critical liquidity zone. My base case is for a short-term pullback from the 0.087 area. This perfectly demonstrates the real hesitation and chatter in the market right now. Even if the underlying business is doing great, technical resistance levels and short-term liquidity play a huge, undeniable role in price action." Which brings us to a really pivotal question, and one I want you to genuinely think about for a second. Can a token actually escape the gravity of the broader crypto market? If a project has real users, real revenue, and real-world assets, does the price of Bitcoin still get to dictate its future? So the crucial point is right here in Section 4, the great crypto decoupling, fundamentals versus gravity. To really understand this debate, you need to understand the concept of beta. Beta is basically a financial metric that indicates whether an asset simply moves up and down with the overall market, completely regardless of its own business fundamentals. The core bear argument right now is that Sky is just a high beta asset. They're arguing that when the broader crypto market is in a fear cycle with Bitcoin dipping, a single token's individual revenue simply doesn't matter. The tide does out and all the boats drop. Sky, on the other hand, is actively fighting to prove that it is not just some high beta passenger, but a fundamentally driven asset that can stand on its own. Okay, let's wrap this up with our final takeaways so you have exactly what you need to remember from this explainer. First, Sky's business is undeniably booming, hitting a record Q1 revenue of $124 million. Second, the paradox of the Sky token dropping is explained by a mix of macroeconomic fear and a major governance pivot. Third, that pivot is the new 4-step treasury model, which essentially pauses massive token buybacks to build a $150 million solvency reserve. Fourth, despite the charts looking pretty fearful in the short term, massive institutional backing remains rock solid. And finally, Sky is currently the ultimate test case for whether strong business revenue can actually beat the gravity of the wider crypto market. And I'll leave you with this final provocative thought to ponder. Will Sky's massive bet on delayed gratification eventually prove that real-world business fundamentals actually matter in Web3? Or is every single token, no matter how profitable the protocol is, ultimately destined to just be a passenger to Bitcoin's gravity? It's a fascinating standoff between business metrics and market sentiment, and we are absolutely going to be watching closely to see which one blinks first. Thanks so much for joining me on this explainer. Keep learning, and I will catch you on the next one.